First up, following the hype without doing any research. This is one of the most common mistakes new investors make. If you're buying just because a stock is trending, you're setting yourself up for a fall. The stock market is full of noise, and it's easy to get caught up in the excitement. Instead, always look into a company's fundamentals and long-term potential. Research the company's financial health, its competitive position in the industry, and its growth prospects. Understand the business model and the risks involved. This will help you make informed decisions and avoid costly mistakes. Remember, investing is not about following the crowd. It's about making smart, well-researched decisions that align with your financial goals. So, take the time to do your homework. It will pay off in the long run. Diversification is key. Putting all your money into one stock might sound bold, but it's incredibly risky. Spread your investments across sectors or industries to protect your portfolio. Imagine if you invested all your money in a single tech company, and then that company faced a major setback. Your entire investment could be at risk. By diversifying, you spread out your risk. This means if one investment performs poorly, others might perform well, balancing out your overall returns. Diversification can be done in many ways. You can invest in different sectors like technology, healthcare, and finance. You can also diversify by investing in different asset classes, such as stocks, bonds, and real estate. Another way to diversify is by investing in different geographical regions. This can protect you from economic downturns in a specific country. Remember, diversification doesn't guarantee profits, but it does help manage risk. It's a fundamental strategy for building a resilient investment portfolio. So don't put all your eggs in one basket. Diversify your investments to safeguard your financial future. Everyone wants to buy low, sell high, but trying to time the market can lead to significant losses. The market is unpredictable, and even seasoned investors struggle to get it right consistently. Instead of attempting to predict market movements, focus on long-term growth strategies. One effective approach is dollar cost averaging, where you invest a fixed amount of money at regular intervals, regardless of the market's performance. This method reduces the impact of volatility and lowers the risk of making poor investment decisions based on short-term market fluctuations. By committing to a disciplined investment plan, you can build wealth steadily over time without the stress and uncertainty of trying to time the market. Remember, patience and consistency are key to successful investing. Mistake number 4, emotional trading. Reacting emotionally to the market's ups and downs is a recipe for disaster. The stock market is inherently volatile, and prices can swing wildly in short periods. This volatility can trigger strong emotional responses, especially for those who are new to investing or have a lot at stake. When you panic sell at the slightest drop, you lock in losses. Instead of reacting impulsively, it's important to have a well-thought-out strategy in place. A solid investment plan can help you stay focused on your long-term goals. Even when the market is turbulent, diversification is one key strategy to mitigate emotional trading. By spreading your investments across different asset classes, you reduce the impact of any single investment's poor performance on your overall portfolio. Remember, successful investing is a marathon, not a sprint. Staying focused on your long-term objectives and avoiding emotional reactions to short-term market fluctuations can significantly improve your chances of achieving your financial goals. Mistake number 5. Not having an exit plan, you've got to know when to sell. Set your goals and create an exit strategy. It's easier to make decisions when you're prepared. Without an exit plan, you might panic during market downturns. Having a clear exit strategy helps you stay calm and focused. It's not just about knowing when to sell, but also why you're selling. Consider your risk tolerance and financial goals. Set up alerts to remind you when it's time to review your positions. Discuss your exit strategies with a mentor or financial advisor. Remember, a well thought out exit plan can make all the difference in your investing journey. If you found this tip helpful, make sure to like this video and subscribe for more investing advice. Mistake number 6. Overlooking fees and expenses. Don't ignore fees. Some brokerage platforms charge fees that eat into your returns. Know the costs and factor them in. Fees and expenses can come in many forms. There are trading fees, management fees, and even hidden fees that you might not be aware of. These costs can significantly reduce your overall returns if you're not careful. For example, if you're paying a 1% management fee on your investments, that might not sound like much, but over time, it can add up to thousands of dollars. Always read the fine print and understand what you're being charged. Compare different brokerage platforms and choose the one that offers the best value for your investment strategy. Remember, every dollar you save on fees is a dollar that can be reinvested to grow your portfolio. So take the time to research and make informed decisions. By being mindful of fees and expenses, you can maximize your returns and achieve your financial goals more efficiently. Everyone has a unique risk tolerance. Understanding your own comfort level is crucial when it comes to investing. It's not just about making money. It's about making sure you can handle the ups and downs of the market without losing sleep. Some people can handle high volatility and the potential for big losses, while others prefer a more stable and predictable investment. Ignoring your risk tolerance can lead to stress and poor decision making. Take the time to assess your risk tolerance honestly. Consider factors like your financial goals, time horizon, and emotional capacity to handle market fluctuations. There are various tools and questionnaires available that can help you determine your risk tolerance. Use them to guide your investment choices. By aligning your investments with your risk tolerance, you'll be more likely to stick to your plan and achieve your financial goals. It's all about finding that balance that lets you invest confidently and sleep better at night. Your life changes, and so should your investments. Reevaluate your portfolio at least once a year to stay aligned with your goals. Many new investors make the mistake of setting up their portfolio and then forgetting about it. This can be detrimental to your financial health. Life events such as a new job, marriage, or even market changes can significantly impact your investment strategy. Regularly reevaluating your portfolio ensures that your investments are still in line with your current financial goals and risk tolerance. Ignoring this step can lead to missed opportunities or unnecessary risks. Make it a habit to review your portfolio at least once a year or more frequently if significant life changes occur. This proactive approach will help you stay on track and make informed decisions about your investments. Remember, your financial goals are not static, and neither should be your investment strategy. By regularly reevaluating your portfolio, you can adapt to changes and ensure that your investments continue to work for you. Don't neglect this crucial step in your investment journey. Stay proactive and keep your portfolio aligned with your evolving goals. Short-term gains are tempting, but they often lead to burnout and unnecessary risk. Think long-term. It's where the real wealth is built. Many new investors get caught up in the excitement of quick profits. They check their portfolios multiple times a day, hoping to see immediate returns. This constant monitoring can be exhausting and emotionally draining. It can also lead to impulsive decisions that might not be in your best interest. Instead, focus on the bigger picture. Historically, the stock market has shown consistent growth over the long term. Educate yourself on the fundamentals of investing and stay patient. By shifting your focus to long-term gains, you can reduce stress and make more informed decisions. Remember, investing is a marathon, not a sprint. Finally, don't invest without a solid plan. Decide on your goals, risk tolerance, and strategies before putting any money on the line. Jumping into the stock market without a plan is like diving into an empty pool. It can lead to disastrous results. First, you need to clearly define your investment goals. Are you looking for short-term gains or long-term growth? Next, assess your risk tolerance. How much risk are you willing to take? This will guide your investment choices. Then, research and decide on your investment strategies. Will you be a day trader, a value investor, or something else? Diversification is key. Don't put all your eggs in one basket. Spread your investments across different sectors and asset classes. Finally, regularly review and adjust your plan as needed. The market changes, and so should your strategies. With a solid plan in place, you'll be better equipped to navigate the ups and downs of the stock market. Remember, investing is a marathon, not a sprint. Patience and planning are your best allies in achieving financial success. There you have it. The top 10 mistakes that new investors make. These mistakes can be costly, but they are also avoidable with the right knowledge and preparation. Remember, a well-informed approach is the best way to succeed in the stock market. This means doing your homework, staying updated with the latest financial news, and continuously educating yourself. Investing requires patience, discipline, and a long-term perspective. Focus on building a diversified portfolio that can weather market fluctuations. Attending seminars and reading books on investing can deepen your understanding of the stock market. Technology has made it easier than ever to stay on top of your investments. Utilize apps and online platforms for real-time stock prices and financial news. If you found this helpful, hit that like button, subscribe for more, and share with anyone who's just starting their investing journey. Don't forget to share this video with your friends and family to help them avoid these common mistakes. Thank you for watching, and happy investing.